Hey, everybody. Welcome to another week of the Wild and Crazy webinar. So first question, without going to any of my LinkedIn posts, and I did not put it in the image for a reason this last week, what week is this week of our weekly webinars? First person to answer correctly, I'm giving away a $25 gift card from Jack.
I was wondering if you're giving my money away again. It's like on TV, they give away like Howie's money on the weekends and for football, and
Oh yeah, well, it's all about money today. So whatever the gift card or swag that Shoemaker may have, whoever gets the right number, and it's over 100 because we had our 100th week anniversary a while ago. I won't tell you how many weeks ago, but a while ago. So let us know. And by the way, if Papa Joe is on, the chat feature has been enabled. We got up early. So yeah, Joe, you are on. Says hey to Saeed. That's great. So today's going to be kind of fun. If anybody doesn't know, this is the third holiday, in air quotes, in the CPA world, 9/15. Here's another question for you. Do you know what are the 4 deadlines that enable and make up busy season in the CPA world? Saeed, you don't get an answer. So you guys know what to do. You can harass us in the chat and you can ask us questions. We do want to have questions because today is really all about what are some money-making moves you can make as a business owner, as a leader of a privately held business. If you're a CFO and you're on here, great, welcome. But what are some money-making moves that you can be making besides taxes today? We've given Adam a break today, but that's why we've got two groups, 3 people. So first group is Zach Kimball of Evergreen Capital Strategies. And Zach is a longtime friend, extremely adept in this space. And we'll talk more about that. When I first met him, he said he was doing the incentives. I was thinking, oh, like trinkets and trash, like I hate saying that, but oh no. So we're way more than that. So don't call him if you need apparel. Then we've got Saeed Modhadam. Thank you for helping me pronounce that correctly. And Jason Houseman of M2H Advisors. And they are going to talk about money-making moves that you guys can make from, cost optimization, supply chain optimization, other things that can help you drive down costs. You will not cut your way to greatness, but if there's money on the table, and there usually is, that's what we wanted to be talking about today. So, and then Jack Santinello, always good to have you here. Okay. Joe says, please include how nonprofits can raise funds. All right. We will, I've got some ideas too. Fairview and Sharon Road is a good place. Just go hang out there. But beyond
my suggestion was find a rich person. So there's my input.
Well, so we've at least contributed today, Jack.
Yes.
So maybe these guys.
I'm done. I'm out. See you.
All right. So do have your questions teed up. If you got anything that's burning, let us know. But Jack, I'd like to kind of toss the ball back over to you. You are wearing your UNC Chapel Hill, Carolina blue, it looks like, shirt. So your NC State family may be disappointed, but you have some updates for us?
Well, I mean, not a whole lot really, surprisingly, and I want to get to kind of the core content. So I didn't even bring any dad jokes with me. I might find one just because no one answered that question about what week it is, which it's above 120, just so in case anybody needs a hint. Surprisingly, and but they're still kind of mulling things around in Congress, and trying to find lever. It is the typical look at Democrats. Again, this is not political. I am not a political person, but Democrats saying, hey, look at us, look what we did, and we're doing all these wonderful things, put money in people's pockets, but yet, and they point to that gas prices had gone down temporarily. They're kind of creeping back up a little bit. There'll probably be an adjustment in relation to that. And so it's, but if you look at the numbers, and unemployment is lower. We had a discussion about that a couple of weeks ago about it being okay, and it was in the context of the people on the corners of Providence and 485 that are with the signs, and should they go get a job? And then it was, can they really get a job based on unemployment numbers? But it's still to be seen. What is the economic impact on all of us as taxpayers with this money going out for these uses that have been passed by Congress and the president, and what the clawback will be. And I think that, again, not being political, but it's just the way it happens in November of a midterm election, that you have repercussions. And so I think the Democrats are trying to reel back potentially what the damage might be. And the Republicans are basically saying, look, what they did, they spent more of your money, but there's been no really tangible results from that. So it's just, again, you guys know that I sometimes spend my afternoons switching between Fox News and like MS or CNBC, MSNBC, back and forth, and it's the same story, but you wouldn't think it because of how it was being spun. So I do that in the mornings between WBT and sometimes NPR. So, but that's basically it. There's not a whole lot really to talk about, other than there's a lot of talk and not really a whole lot of substance coming down the pike at this point.
I just wish everybody that is in a professional politician role would have to run the country like we have to run businesses profitably, or we're out of business. So anyway, we're talking about money today and what can you do. So I think I'm going to throw it to Zach first on the incentives, because I told you he doesn't do trinkets and trash and your logo here, but talk to us. And it's not just tax incentives, right, Zach?
Yeah.
So why don't you talk to us about like what you guys do and how you actually help small to medium-sized businesses and nonprofits for Papa Joe.
That's right.
So that they can think about, maybe that applies to me or what it doesn't. Also talk about the industries, et cetera, what they should be looking for.
Yeah, no, I appreciate that, Gary. And, really where our primary focus is on Evergreen Capital Strategies is the incentive space. That can mean a lot of things. So we're primarily focused on maximizing and negotiating the incentives tied to any capital spend, any job creation, any infrastructure needs related to any project around the country. So this could be taking out old lines of machinery, putting in new. You have a new tax base. This could be adding 10, 20, 30 jobs over the course of 3 years. This could be a greenfield project. If you're expanding your operations, you need road, water, sewer needs. Those can typically be offset by the states, the counties, any of the granting entities out there that are able to offset the upfront capital costs of a project and the ongoing operational costs. So when we talk about incentives, we're not talking about tax credits. We're talking about what we like to call real EBITDA enhancing incentives. So for all our finance folks out there, these are going to more or less enhance the ROI of a project. And so mid-market's been totally underserved. You read about Amazon getting whatever it is from states, counties. So the mid-market space is really one of those underserved markets where we've been incredibly successful, to where, if you've got a project over the course of 3 or 5 years that, I'd say a baseline of 10 to $15 million, we're typically finding anywhere in the range of 10 to 20% sometimes of that capital number back to you in these incentives. So That's our true niche in the marketplace. And when we meet with a lot of folks who have had experience in this, we like to see what they've done in the past, right? So being success fee based, we want to make sure that is there an opportunity for us to add value. So have you done incentives in the past? What did you leave on the table because you didn't know it was truly negotiable? And we deal with that with a lot of foreign direct investment coming in from Western Europe, Japan, sometimes China, to where they have no idea that you can negotiate a lot of these incentives, be it a maximized property tax abatement, more cash for particular jobs, land grants. There's all sorts of discretionary incentives that aren't publicized by design, so that the states and the counties can get these projects there for the least amount of money on the table. So we're really the equalizing force to get your clients and our clients the most amount of money for their project.
Yeah, that's good. So you said kind of the sweet spot is if there's a $10 to $15 million spend on a project. What about, where does it make sense if somebody's got capital, CapEx improvements, like they're taking out a line or whatever, it might not be $15 million. Where does it make sense to get you guys involved, Zach?
Yeah, great question. So I'd say a good baseline is really, and you have to think about this over the course of years, because every state's a little bit different in the window of investment and job creation that they'll allow. Some states are 3 years, others are 5 years. So we try to work with our clients to make them understand that let's not only think about the initial investment you're making if it's an expansion, but if you're taking out old lines, putting in new to the tune of $2 or $3 million a year, when you add that up over 3 years and aggregate all those costs, it adds up to a project that's $3-5 million. That's worth, depending on where it is in the country, right? So if you take $3-5 million in Houston or even Charlotte, you may be lucky enough to get a breakfast from the economic development folks. The further out you get out of major metro areas, those thresholds can get a little bit lower. So I'd say, if you're doing $3 to $5 million at a very minimum over the course of 3 to 5 years, it makes sense to at least have the conversation to delve a little further in that.
All right, cool. All right, I'll throw a ball back to you in a little bit, but I want to get Saeed and Jason on here. So Saeed and Jason are with M2H Advisors. And the question I'm going to throw to you guys is, give us an overview of what you do, what the sweet spot is, what you're looking for, and some examples recently of where business owners are turning to you and you're finding real stuff for them to also help their CFO look good so they aren't embarrassed. Oh, why didn't you know about that before? So I'll let you guys take that.
Okay. Jason, I'll let you start and I'll fill in.
Yeah, sure. Thanks, Saeed. And Gary and Jack, thanks so much for having us on. And thanks for the plug last week. That was, not something we had planned for. So it's good to hear and glad our conversation went that way. And good job pairing us with Zach too. I think it's a natural fit. He talks about, how the middle market's underserved and that's really where we're focused as well. And again, on success fee based is where we align, pretty well on our services when we talk about cost reduction. So, M2H in general, what we're focused on is helping businesses get ready for sale on the for-profit side. Part of that process, though, is cost reduction. So when we think about, our middle market customers and cost reduction, we're working with a consultancy of over 800 people throughout the globe in over 30 countries. We've been around for 30 years. Have completed 35,000 successful projects just through our membership with ERA. But I did hear a mention of not-for-profit. I like to throw that in there too, because when Saeed and I are talking to clients that are looking to sell, obviously those are for-profit. But when we're looking for optimization opportunities, we can work with not-for-profit companies as well. And again, through our affiliation with ERA, we've done a number of projects on that front as well. I'd say where our focus is in that core middle market space, We're working with dynamic management teams. These are folks that get it. They're folks that are incented by the bottom line. They want to see an improvement in the business. They understand that a dollar earned may be worth 15, 20 cents to the bottom line, but a dollar saved goes straight to the bottom line. And then there's a shared belief that somewhere in the supply chain, there's money being left on the table. So it's not generally to go in there with folks that say, oh, we don't know what we're doing. We need help. Come on, take a look. It's folks that know what they're doing. They have the focus, but they realize that their time and their resources are rather limited. They know a ton about what they sell. Most of our clients are very focused on who they sell to and what they sell. There's probably less knowledge base around their supplier base and the inputs into what they sell. So when they bring us in to take a look, we're focused on anything from, we'll call it insurance and bank fees, all the way to, packaging and freight and industrial consumables. So there's a lot we can do in there. Typically focus on, I saw in the last podcast, or you talked about the 80-20 rule and held up a book, and that's where we come in as well. We look at that 20% being the the tail spend for a business. Where can we pick up easy, profitable projects within categories that are not necessarily going to have a great deal of effect on how you actually operate. So and you asked for an example. I'll give you a quick one. Working with a client now, they came to us and said, we're spending, I think it was about $3.5 million on corrugate for just packaging products and sending them out the door. Having trouble getting this type, and our cost has gone up dramatically over the last 12 months. So we took that project on and said, all right, well, give us the specs. Let us understand better, what exactly you're buying or what it's used for. Engaged with some engineers within our network. Said, all right, you don't necessarily need what you're buying. You could buy this. And by the way, we can take it to RFP and find a provider for that. It's more readily available, and you're going to save 40%. So that's one of the examples of just bringing real savings on essentially a category that, it's got to be done right. But, one type of cardboard or one provider of cardboard versus another, it's not really all that glamorous, or, isn't going to be all that impactful to the business. They're going to save money, which is a big part of it, but the on-time delivery and being able to get the product and everything will be improved. So that's one of the examples.
As Jason said, our goal is to really roll up the sleeves, get to know the owners, understanding their goals. We can come in short term and do the project and then move on, or stay along the ride and help them continue to optimize their business. Oftentimes we find that business owners may not be aware of that. Like Jason said, there's certain things that we can do differently that can make impact to the bottom line. And so doing part of that preparation process, making them aware, helping them really feel good about where the business is, making sure that we don't leave any money on the table for them. And if they choose to sell, great. If they don't, that's fine. We'll continue to stay aligned with them, help them along the way, and bring our resources in. So within our membership with ERA and our collective partnership and network that we have, we bring that together and really help shepherd that along the process for the client. So that's our goal. And we can help with the transaction as well. And so sometimes in that transaction, there may be a niche business that we may partner with another investment bank that would be better served to take care of the client. So our goal is to really kind of be a trusted advisor within that ecosystem of who they use for those key decisions. And it starts with really understanding where the business is and prepping them for a potential exit if they wanted that.
So for everybody that has been on these programs before, like Papa Joe and Robert Mayetta, you're probably on here too. You guys have heard us talk ad nauseum about succession planning and what do you do to maximize the business. And the fact that you need, if you're really going to maximize the value of the business, whether you sell it internally, to whomever, or you get it ready for strategic or some sort of a private equity acquisition in the future, there are a number of levers to be pulling, but you need to be starting 3 to 5 years out, ideally 5. and just kind of take one bite of the mountain at a time and move methodically. And the thing is, even if you choose not to sell, you have a much more efficient, well-running machine that's a lot more fun to run too, quite frankly, because one of those things is minimize all the roads leading to you, the owner. How do we minimize that? But then where, to know that you're squeezing the costs, still have the quality that you need, et cetera. But a lot of times you don't know about other opportunities out there. Well, we've always done it this way. We've always used this provider, et cetera. And I love loyalty. It's also good to know, hey, for this particular niche, this group is better served, and to serve you. You just at least need to be armed with information. Ignorance is not bliss. So that was something that I wanted to
Hey, Gary, I want to
highlight.
Share a simple analogy. What I always tell people, business owners typically we work with may have never sold a business. So it's a first time event if they ever did it, or even thinking about that. So it's their baby. It's very emotional. It's a hard decision. But I always tell them it's always good to make sure, just like your house is always ready to sell, have it ready to go. Should something happen, God forbid, if it's a health issue or involuntary or voluntary matter that you have to move quickly, oftentimes we find people rush, the financials are not in good order, the house is not in good order, and it becomes a very challenging transaction. I'll tell you about an example. Recently, I'm working with a client that's in the construction industry, and good example of how he's wearing way too many hats, doesn't really know what's going on in the business, and he's overwhelmed to the point where he has to go into a hospital because he's carrying the burden of the stress, and all he's doing is putting out fires. He's not in love with the business right now. He's reactive. And so what I'm trying to help him do is helping him unpack, putting some delegations in place, bringing some resources to understand what his business is doing today, what can he do differently, and he's slowly starting to feel a lot less weight on his shoulders, be able to work on the business and growing it. And it's just a couple months, and we've seen great results. And those are some of the things we do where they may fall back in the love of their business. That's what that'll be a wonderful thing. A business owner, as they grow, they have to start releasing those hats. They're trying to be everything to everybody just doesn't work when you get bigger, and you're going to carry too much weight on your shoulders, and it just becomes very stressful. So just trying to share that example that the importance of what we do also can help them really enjoy what they started a business for.
Yeah, that's the truth, man. We've all seen that where they don't love their business anymore. It's like they hate it. I've seen that and I've seen it way too many times where it affects the health of the owner or the person carrying the ball, man. I mean, stress is a real deal. Andy Tucker, it was so good to see you yesterday at our business growth workshop that Jim Dunn does every quarter for our clients. Did a great job yesterday. I had to go yesterday was 9:14, today's 9:15. Some of my team needed me to help with some clients getting information that should have been in about a month ago. And so anyway, I missed a lot of that seminar, but it was good to have Andrew Tucker here. And he said, great advice. Even if you don't sell, the business is more valuable, more efficient, and better positioned for the future. And that's an important part. I have a good friend that recently sold for about 5 times what he was offered 4 years ago. And I've been able to coach him for the last and his team, and it's just been so much fun. But the guy is freaking miserable now. He is so unhappy that he's glad that he got the money, even though he hasn't spent a dime of it. It is a lot of money. But he was so emotionally tied up in what he does, and he loves his people. He loves his people. Well, they've got these massive golden handcuffs on him. He can't touch them for like 5 years. I mean, it's something ridiculous. Should have had Jack, negotiating on that behalf. But one thing that I would say too is if you are thinking about selling, make sure you're running to something and not running from something. Just because, oh, hey, the market's hot, Now I gotta, sell at the peak. Well, this guy sold probably at the peak. It doesn't really matter. It really doesn't matter. Make sure you're running to something instead of running from something. So we've got another question that had come in here from Bruce. I don't know that I'm qualified to answer this, but I'm going to throw it up as a jump ball to any of y'all. But since we're talking, and this is from Bruce. Bruce, thanks for weighing in on this. Since the topic of not-for-profit organizations was raised, for not-for-profit organizations and perhaps some small businesses, some owners and managers have a serious process for collecting and reporting in-kind services and any in-kind asset donations. Many do this as a sign of appreciation to those in-kind partners. What are the best practices and guidance, as well as absolute necessity for transparency and reporting? That sounds like a tax thing, and I would like to make sure that Adam Boatsman is on tap for that, because as I told these guys before we went on the air, I did not stay at a Holiday Inn Express last night, and I am not a CPA, and I'm not going to pretend to be one. So anybody have any thoughts, or do you want to just pass that hot potato to Adam?
Well, I would just say that Adam would certainly be, from the CPA standpoint, be able to provide more context. But I do think having clarity, transparency, especially when you're bringing in funds and you have a fiduciary responsibility, I think having that top of mind and done right is definitely the right way to go.
Yeah, and it's also, I think, a matter of, and I also agree that I am not a CPA, and so this is a friendly advice, not even legal advice.
And you don't play it on TV either.
No. Sometimes I dress the part, but that's about it. So it is about what is reasonable value. So you can't say, well, the in-kind services are valued at this high amount, and that's the amount that you report as being a charitable deduction or a marketing expense or whatever it is, that depending on whether it's a 501c3 type donation or not. So it becomes a matter of and also it may be that value isn't the value provided to the nonprofit is maybe different, because there may be in-kind services coming back the other direction. So it's kind of like when you go somewhere and you donate money, but you're getting a lunch or you're playing golf or you're doing something else where you are getting a benefit back. So the amount of money that you are donating to or contributing isn't the amount of money that or the value that you're going to put on your tax return as being a marketing expense or being a charitable deduction. So that's my 2 cents on making sure that it's the appropriate value, which may be different than the actual check that you stroke for whatever it is.
So thank you, Bruce, for asking that. If you guys have any other questions, hit us up. That's what we're here for. I mean, this is for you. Free advice from some really smart people that are willing to give their time to help you, because we are, one thing about all of us on this call, and Adam and the folks at BGW, I know too, we care about helping businesses grow. And we say, save money, make money, stay out of trouble, and have fun. And we're really serious about that, because I don't know about you, but I love living in Charlotte, North Carolina. And Charlotte, North Carolina is a beautiful place, but it's a better place because of business owners that are willing to risk their capital, employ other people, and if they're doing it right and they're treating their people right, and connecting good people to good people, that's what makes this community so special. And it's funny because all of these guys on this call, I didn't know, but they kind of knew each other, which is pretty funny. So yes, Jack, raise your hand.
So you may already have like your slate of questions, and this is probably on it, but I think that it would be appropriate to ask our guests what they see as the, and I'll call, this is my firm terminology, the WTF moments when you're going through and evaluating a company, whether it's the financials or their processes, procedures. So what is kind of the low-hanging fruit that you see that you can pretty much immediately say, you need to change these things? So whoever wants to go first.
Great
Go for it,
question.
Jason.
I was right next to you, Jack, so I feel inclined to answer this one. But I think, and Saeed had mentioned this, that most of our engagements are predicated on a potential future sale of the business. So optimizing cash flow for that future event is kind of highest and most important on that list. But a lot of times we're engaged to resolve other issues at companies that maybe they're not intentional about wanting to sell the business at a certain point in time, but there could be other issues. They may have liquidity or cash flow concerns, and that would tie into what's going on at their bank. Are they clamping down on their bank covenants? Are they missing covenants? Are there is the bank pulling back some of the funding in their lines of credit? We see a lot with rising wages or supplier costs. So obviously, in times of inflation, people are looking at this saying, all right, I have to pay my employees more. Where can I find the money for that? What are some of the other resources we can, dig into to try and free up space to make sure we attract and retain talent? We see a lot with supporting rapid growth. Companies that have grown acquisitively over time tend to change their processes. They tend to put everybody on the same systems. They don't necessarily put everybody in the same supplier base. The supply chains could be all over the place for one entity where they could really come together and create a concentrated focus and achieve greater savings there. Contract renewals, companies that are looking at renewals with existing contractors, and some of them are on auto renewal clauses, and they're not realizing that if we got out of this and went back to market, maybe there's an adjustment to be had. A big one for us is initiatives that are either underfunded or unfunded. So business may have a growth goal or a target of something that they want to achieve, and say, where are we going to get these funds from? Can we borrow it from the bank? Do we raise capital? What do we need to do? Can we just look at what we're doing now and create some improvements there? We can provide support through additional transparency. We can show people what they're purchasing, how much they're purchasing, what it costs, and say, all right, these are opportunities. And a lot of times our clients don't have the time to put into. They don't have the resources or the expertise to say, all right, look, we do need to do a full scrub of our supply chain and figure out where we can improve our costs. But we don't have the time to do that. Our CFO is focused on high level strategic initiatives. Do we want them diving down into the supply chain to renegotiate waste contracts? That's typically not a good use of your CFO's time. So it's about creating value. It's about improving profitability. For our not-for-profit folks, it's about being a better steward of your funds. But overall, it's if there's someone inclined to want to improve the business, there's a way we can help. And if you can kind of check ego aside and say, all right, maybe these guys do have something, and whether it's one of us or one of our subject matter experts that we're drawing from the industry to say, hey, we know you have a proficiency in waste collection, let us leverage that and get us better costs on it.
And one thing, Gary, and I want Jack to share something as well, but one thing I think is important to note, a friend of mine gave me great advice a long time ago. He's a consultant in a world of lobbying up in DC. But he said to me, one of the things you want when you speak to a business owner, understanding what's keeping them stressed or excited and stressed, understanding where they're at and helping them with those things. Sometimes, our job is not to dive in and say, hey, these are all the things you can do. We want to make sure what's the obstacles in front of them that's causing them pain or excitement, or they have a growth initiative, they just don't know how to fund it, or they're stressed because their payroll is high because they're not managing the cash flow as well. So we try to be very intentional understanding where they are in that point in time. And as the relationship grows, we can start unpacking the other stuff. So it's a little pieces at a time versus overwhelming, because most times they're already overwhelmed as it is. They're already at a point where they're stressed out. And so we don't want to say, hey, listen, your house is on fire. We got to do everything now. We try to take it one step at a time, which is the priority, prioritizing what's most important to them.
Yeah, Gary, I'd say on ours, it's pretty easy. It's pick up the business journal as a resource in any location, and we cringe. It's like reading a postmortem report because we see projects announced, be it expansions, new builds, or just reinvestment in their own plant, and they left 50, 100, 200% on the table. They just did not know that they could maximize incentives related to particular spend, job creation, infrastructure. And then when we dig a little bit deeper, this function in, hey, we're going to do a project maybe once every 5 years, 10 years, it doesn't really fall in anyone's P&L necessarily in any company, large or small. So typically sometimes we see HR doing incentive negotiations with states and counties because of the employees. Sometimes typically it falls into a finance function. We've seen legal get involved. So, we're firm believers in the old Peter Drucker adage, and do what you do best and outsource the rest. This is one of those events that doesn't happen on a daily basis in a business. So that, if you are looking to spend capital, and the beauty is, a lot of small business owners who are looking at reinvesting in locations, they come to us and say, how am I going to get incentives? I've been here for 20 years. I'm captured, right? They got me. The state's got me. What more can I offer? And we say, well, if you're reinvesting and creating new jobs, that's a new project that you didn't even know about. So we can aggregate that spend over a period of years and job creation and the wages associated with that. That's meaningful. So, the unicorn to the states and the counties across the country has always been new projects. Foreign direct investment is even better because they get to wave the flag and say, hey, we got XYZ business in our locality and it's great for future business. More and more now we're seeing as some of the pipeline dries up in some localities where their job now is just to retain talent, especially with the labor pools being the way they are. Retain the investment that's in your community already, and especially if there's multiple locations to where a business has, they could put their capital in Knoxville versus Houston, and incentives can play a part in that. And I think the communities realize that if a company stops investing in their location, the writing's on the wall. Either it's not going to flourish or it's going elsewhere. So it's incumbent that you take all of that into consideration to make sure you're getting the most for your capital spend.
So we've got some good questions that have come in, but I've got to leapfrog over those because I wrote one down earlier and it has to do with job creation. Zach, how many jobs do you have to be creating, or what are the things that, are the hurdles that once you've cleared this minimum hurdle, it's worth talking to you about?
Yeah, I'd say, anywhere north of 15 jobs is worth talking about. In Charlotte, the Mecklenburg County, it's going to be a higher threshold. It's going to be, north of 30 with an average wage of 55K. The localities that can be picky are picky for a reason, right? They want the jobs that they want. They want the industries that they want. So I'd say good rule of thumb, 3 to 5 million investment, 15 jobs. A great point, very topical. We just closed a deal in the middle of nowhere in West Virginia where it was an expansion for a manufacturer. Historically, when they went there, they got 30 grand of infrastructure paid for by the state. They were doing about 7 million in capital investment in expansion, creating 20 jobs at 30K an average wage. But it's really the only show in town. We secured for them a $1.2 million incentive package, which 700K of that was cash up front.
Wow.
So, I mean, it always surprised, and we love the reaction. It's like, whoa, I had no idea. And so that's why we exist. So they don't have to be mega projects, I guess, is the moral of the story.
Yeah, that's good. That's really helpful. So speaking of funding, this is a jump ball for any of you to answer. How do you, and this is from Andrew, how do you consider underfunded buy-sell agreements?
think we defer to council on that one.
Well, I was wondering that it was, okay, so I mean, is it like when you say consider underfunded, Andrew, you're asking about in the kind of evaluation process when you come up upon a buy-sell arrangement in the due diligence process, and then you see that, well, wait a minute, there's not enough funds for that, or whatever the mechanism is for that. And that comes up in the context of, it actually, I bring it up in the context when I'm forming companies or merging companies, and you have the ownership, when I have the attention of the ownership and we're walking through the what ifs. What if somebody gets hit by a bus? What if somebody wants to leave? What if, and the way I look at it is that when there is a triggering event, let's say it is a death of one of the owners, that what happens? Well, typically what happens is that the estate of the decedent partner momentarily holds that equity ownership because that's part of the estate. It's an asset of that individual. And then you look to the governing documents, whether it's a shareholders agreement or an operating agreement, that will guide as to what happens in that instance. The typical default is that you want to treat both sides fairly and continue on with the intentions of the owners, which is typically that you want the estate, the family of the decedent owner, to receive money and cash out to be able to move forward and not be wedded or bound or tied to the business necessarily for that essentially annuity, that coupon that they're clipping at the end of the year with their percentage of net income. And similarly, on the other side, you have a business that maybe is owned by a handful of individuals. One of them passes away. Do they really want to be in business with the estate of or the beneficiaries of that decedent owner? And typically the answer is no. And that, so those 4 remaining owners, let's say, want to move forward with the business. They are involved in the business, and so that is the majority of, more than majority of cases. The minority of cases is that, let's say those 5 people have come together, they've built this, they've built the foundation, they've built divisions, they just continue to grow this business. And if you were to ask that person, what do you want to happen after if you get hit by a bus? And the answer may be, I want my family to be taken care of off of the backs of these 4 other people. Yes, because the 5 of us built this foundation that then grew this business. So yes, I don't want them to be cashed out at present value. I want them to receive the benefit of the growth that I helped plant the seeds for. So, and then a kind of a side note of that is, many times there is insurance related to that buyout, whether the company owns the policy or the individuals own the policy, who the beneficiaries are, who's paying for it. If the company is paying on behalf of you as an owner, then that's really taxable income to you that you're going to have to pay, potentially pay taxes on, because it is a benefit that you're receiving in lieu of receiving cash, possibly. So, but what happens is it's set. And if you don't review that on an annual basis, so I tell my clients on an annual basis, obviously you're looking at past performance, you're looking at pro formas, you're setting a budget for the following year. Well, I say, hopefully my clients are doing this. Prior performance, historical performance, pro formas, looking to the future, and then reassessing the key tools to the business. And one of those tools is the insurance coverage. So let's say that you purposely got a policy that covers 80% of the buyout of any of the partners in that moment in time. Well, imagine as the business increases, and so you have the value increase. So now it only covers 76%. Now it only covers 68%. So you may have to increase the principal or the payout on that insurance policy, which then might even be a little more difficult, because we get older as time goes on, and okay, are they going to take blood from us? Are they going to look at our medical records, that kind of thing? Are we insurable, or is it going to cost more as we get older? So all those, I went way off on a tangent, but just so you understand, there's a lot of considerations, that it's not just a matter of just getting a policy and letting it sit. But it's also a consideration as to what do the owners want to happen if there is a triggering event. And I think a lot of my clients take that for granted before they come to me. It's like, here's my operating agreement. We just had someone that is or wants to get bought out. What do we do? And a lot of times, put yourself in a situation that recently, so a company that was formed in 1990, 4 fraternity brothers got together. They have a very large, successful international business. One of the 4 has kind of gone off the deep end and has made some significant bad financial decisions with the division that he was in charge of, and they want him out. And they basically sent me the documents, and I said, this is the math. And they said, do we really have to pay that amount to that person? And I said, yes. And they're like, well, that's stupid. So I'm like, why is that stupid? And I know what they're going to say, because I had this conversation, a couple times a year. It is, well, we've been paying him a shit ton of money over the course of the past several decades. We've paid for his car. We've paid for his business trips to Vegas to go to conventions and bring his whole family. We've paid for this. We paid for that. So he's received the benefit of being an owner and money on top of that. But you're saying that if we want to buy him out, this is the formula that we agreed to in 1990 in this 10-page shareholders agreement or operating agreement. So beware of that too. I mean, know where the pathways are under certain circumstances in your governing documents. Don't wait until something happens before you realize, oh, wow, okay.
Yeah, that's great advice. Often, to your point, Jack, often starts off really amicable, bunch of buddies or friends, and then unfortunately sometimes things like this happens, but then they go back to these documents that are all dusty, and they're like, wait a minute, as much as you may not want to, it's there. So legal review is one of the things we're really big on, engaging, understanding where they are, where the legal risks of the business in preparation for sale. Because to Jack's point, there may be something that they're completely unaware of that will come back to haunt them in a transaction. So legal review is another part of what we think is really important, that preparation process.
Yeah, good one. Papa Joe, you've got another good question here, and this is a jump ball for all of you, because you all touch it and see what's going on out there. But 1 year ago, there was a lot of private equity money available for owners wanting to sell. What's the current status?
I think private equity right now, the capital markets is definitely kind of under caution. I've talked to one of my good friends at Carousel Capital. They said, listen, we're not buying thing unless there's something that's really, really good and it's at a reasonable price, we're going to buy. But at this point, it seems like a lot of people are kind of wait and seeing, what that is. And banks, I've talked to a few bankers where I ask them, hey, listen, talk to your credit guys. At the end of the day, those are guys who are making the decision on what's going to be who they're going to lend to and not. And then, across the board, it seems like there is a little bit of retracement of how aggressive they are. And so that leads to kind of what Jason and I really believe in, is that times like this, even in advance of times like this, having these awareness that, hey, listen, at the end of the day, my spending is intact. I got to understand how I'm doing it right. And it also helps you, looking back in 2008, when people knee-jerked and had to make some really tough decisions, they often let go of people, fired people because they felt like that was the right way to go about it. But they didn't realize that maybe there was some things within their expenses that could have saved a good handful of those folks. So this preparation of what is potentially a economic downturn, who knows exactly where that goes, right? So prepare for the worst, hope for the best, but be intentional about how you go about it.
So I got a question for you, Saeed and Jason, with regard, we've got a ton of good friends that are good bankers, like good commercial bankers in town. And, there are a lot of really good ones. And what you need is a good commercial banker with a good commercial bank that fits your needs. And there are a lot of good commercial banks out there. Some of them, as we saw in PPP, the big ones kind of tripped all over themselves. The smaller and more nimble ones were like speedboats, and they helped a lot of our clients. And so it made them kind of reconsider their relationships what do you guys do in your business and M2H Advisors with evaluating banking relationships and also being careful to not like just go into the traditional big corporate procurement department? Well, we can get this widget for half a cent cheaper, and it's crap, but it doesn't matter. It's a half a cent cheaper. How do you maintain trusted relationships, but still have and do what you do on the banking relationships and evaluating how you best serve those clients?
Yeah, great questions, especially for two ex-bankers. So both Saeed and I came out of the corporate commercial banking space, so have a really good understanding of it. Yeah, I think for us, it's understanding the fundamentals of what banks look at. So if we understand, the profile of the business, we can help to better understand what their capital needs are. And if their bank isn't meeting those, we can either address it with the business and say, here's where you're lacking, or we can say, all right, this bank is just, their credit appetite has changed such that you are no longer the profile that fits their target, and look at other providers to try and boost that up. But I think having that perspective of looking at it from a bank's lens, it does provide some, I guess some better perspective for our clients, so they understand. All right, yeah, this is really what's important to the bank, and if we're not meeting these targets, that's why we're not, getting what we're asking for. In regards to the question on, save a nickel on your widget, the way we run projects on the expense reduction side is that we kind of level set with our clients, quality that they want. So up front, it's, what are your quality thresholds? And all of our projects are meant to improve the relationship. So it's going to improve quality, it's going to improve value. And at the end of the day, because of the way our process works, we're presenting options to our clients versus saying, here's the solution, take it and pay us. Ours is, here are some solutions, you can pick from any of these, and we're going to stick around to monitor it. And, kind of like what Zach mentioned on the success fee basis, we're the same way. We're paid on the back end. We're paid when you bought the new product for the new price, and we benchmark it against what you were paying originally, and that's where we get paid. So take the risk out of it.
One thing I want to share about the banking piece of it, that's a great point that you bring up, Gary. In times that things get a little bit tough, when I was in the 2008 world, it was times where the banks were pushing people out, and people remember those things. The same with it happened during PPP. So I always tell people it's really important to understand kind of why you chose that bank and the banker, to make sure that they like the industry. Also, the industry, the more they understand industry, the more aligned, because sometimes they'll put a governor on it. If they don't really understand, but the guy had he had good cash flow, he had good personal balance sheet, they're like, oh, we'll give him money. But they're not dynamic to grow with them and really provide the resources in order for them to achieve the goals they're doing. So it is really important to have that. And sometimes I told them, in light of what happened in 2008, maybe having a secondary relationship just to have some back fill in case something goes wrong or the appetite of the current bank changes. It's always good to have a little bit of that. But and then going back to what Jason shared about the widgets, our goal is not to just throw our fees out there. That's, everyone can do that. But understanding kind of the consulting side of understanding what they want, and then leveraging our resources and subject matter experts to really define what could be beneficial to them. So it's more consultative than transactional, and saying, hey, Gary, you spend $1 on this, we got it down to 50 cents. Gary says, great. But then Gary suffers quality issues, customer issues, shipping issues, and like, well, we didn't solve any problems there. We made more.
Great point. Great point. That was my biggest beef with the procurement departments and one of the largest banks in the country that I worked for, because it's like they were just bottom line. They had no clue what they were purchasing in some regards. And I was like, we're idiots. It's like there's more to it than just that number. So anyway, a couple thoughts and a question. First of all, with regard to the first question that we had on the front end, I'm going to give you guys one more chance, because what week is this? And it's more than 120. and it's less than 130. That's what I'm going to tell you. So Jack's got a Starbucks card or something for you. I'm giving away Jack's money. This is so much fun. One other thing that I want to mention, I don't know, it's been a while since we've talked about this, but insurance, especially health insurance, that's a huge nut for everybody. There is another firm out here that I'm actually having lunch with him today, Jeff Warner of Pear PEO. And what he does is kind of what these guys do. You don't pay him a dime. He actually gets paid by whichever PEO you guys choose, but not every PEO isn't the perfect solution for everyone. But basically think of it as a PEO manages the health insurance, and it's a co-employment situation. They're still your employees, but technically there are ways that they absorb the legal liabilities for workforce and all that, and they have much better purchasing power on health insurance in particular, and some of those benefits. And it's getting more and more complex in the legal world, Jack, just because, we live in a litigious society, unfortunately. And so you can offset that. But if you're ever considering a PEO, or if you're in one and you're not happy, Jeff Warner of Pear PEO has built a really good mousetrap, because he gets paid by whichever PEO. So he will bring you an assortment based on what he thinks your needs are and based on talking with you. But it's a really good process. We're going through it ourselves with him. So plug for
Gary,
him.
we work with Jeff closely, and I would echo your thoughts on your comments on that he is best in class in how he approaches it. Think of him as an insurance partner, where you have a broker where they work with multiple different companies. So he really works for you. He really understands the business. He works with some of the big shops as well. He understands what makes sense, and he's also very hands-on post-close too. So I encourage you, to listen in or meet him whenever you have his moment. He's really cares and consults really well on what the world of PEO offers.
Yeah, that's good. Well, you guys have done a really good job today. Thank you. Thanks for all the good questions too, and the engagement. We had a nice group of people. We had 26 people on the line today. And for those who came on late, we will put this up on the BGW CPA YouTube channel this afternoon. One final thing that I would say is, if you like meeting other business leaders and owners in particular, and maybe they're number two, kind of COO kind of person, and you like to spend time like doing some strategic thinking, and you would like to meet other folks, and you're not being sold anything, you're not around a bunch of salespeople that like being with business owners, but you're actually with business owners, and you're a BGW CPA client, put this on your calendar. December 14, Jim Dunn is going to be doing another business growth workshop at BGW from 9 to 12:30. We just finished it yesterday. It was our third one for the year, but we do that for our BGW clients, and we do not charge a dime, and he used to charge a good fee for that. So it's a good place to have a little think time with you as the owner, but also your second in command, and be around other people to hear what they're doing. So I'm a huge believer in forums like Vistage and YPO and EO and those kind of masterminds, et cetera. It's an important thing. Andrew gives a good plug. Great workshop by Jim Dunn. He was there yesterday, so it was good. So anyway, that's what we're here to do too, is just facilitate and give opportunities for you guys to meet good people that are going to take care of you and treat you right in a safe environment. So thank you to each of our panelists today. Jack, always good to see you. Jason, Saeed, and Zach, we really appreciate you guys taking the time out of your busy schedules to help address these questions. How can they best reach you, Zach? What's the best way for somebody to reach you?
LinkedIn, our website, Evergreen Capital Strategies with an S.com. email is zkimball@evergreencapitalstrategies.com, and happy to advise on any spend and job creation you're looking at.
Great. Thank you so much. Jason and Saeed, how do they reach you guys?
Yeah, I'd say the same for LinkedIn. We're all over that. M2H Advisors.com is our website. And then email addresses are Jason at M2Hadvisors.com and Saeed at M2Hadvisors.com.
Please reach out, and if we're going to help you, just talk through some things, thoughts. If we can help you complement something you're doing with a client, please, we're happy to do so. Our goal is not to say no. We want to be very helpful. I think a lot of, Jack and Gary and Zach, we share the same sentiment. We want to be a resource, and if we don't know it, we'll get the right people involved.
That's right. Sure appreciate it. And everybody knows how to get hold of Jack. Yeah. Have a great rest of the week, y'all.
Thank you. You take
Thanks,
care.
Gary. Thanks, Jack. Good to see you
Next
guys.
week, we will be
See you
back
guys.
for week 129. I'm just saying. Next week's 129. See y'all.